Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review it wherever you're following or listening to it. With me today, I'm happy to have on for the second time the team from Cove Street Capital. Actually, for the first time, we've got Jeff Bronchick from Cove Street Capital. And then for the second time, we've got Andrew Leaf. Andrew, Jeff, how's it going?
Great. Andrew, hold on. What stock did we talk about last time? Just so I know if Andrew was going to hate us here.
I don't know if you want. People can look at the chart. It was Viasat. It was Viasat.
So hold on. So we should probably be, shape shifting over, but let's stick to script, shall we?
We can shape shift over. A couple people were like, "Oh, this is timely," and I said, "No, I did a lot of work on Ecovyst, but we can shape shift."
We'll do the 5-minute drill at the end if you'd like.
Perfect. So before we hop into all that, let me just start this podcast off by reminding everyone a quick disclaimer. Nothing on this podcast is investing advice. Please do your own research, do your own work, consult a financial advisor, all of that. This isn't financial advice. Anyway, guys, the stock we wanted to talk about today is Ecovyst. The ticker is ECVT. I'm actually really glad Jeff kind of brought it up that he wanted to talk about it with me, and I'm really glad he did because two investors who I consider some of the sharpest I know that I have been interested in the refining space in general for the past 18 months. And they said, hey, this might have all of the plays of a refiner and then some because it's a really interesting product. It's really moody. It's absolutely mission critical. But I'm rambling. I'll turn it over there. Jeff, Andrew, either of you can start. What is Ecovyst and why are they so interesting?
Got it. Yeah, I figure we'll divide up into, obviously I'm just a talking mannequin and Andrew is the Oz or the brain in the enclosed glass thing. Okay. Yeah. So I think what was interesting, and thank you, and all the disclaimer stuff that you just said, Marianne Tynan, our compliance person. Okay, good. It's besides a good company, and it's always nice to find good companies that are underpriced because you rarely get good company cheap stock at same time. And there's been some I guess external institutional investment industry things that have caused this that we believe are have relieved themselves after frankly smacking us for the much of the past 2 years, and I'll go into it. But long story is we track failed IPOs. It's just that simple. And this was a failed IPO. And though everyone can look at exactly what PE firms I'm about to malign, it's this classic of, there's a lot done in PE with hundreds of billions of dollars that just makes zero sense except to generate fees and conceptually performance. And this was one of them. And CCMP put together privately two groups of chemical companies and took them public back in, actually they started the deal in 2014 when IPO'd in 17, but it just had it was name on paper. It could be constructed as a whole company with a narrative that made sense only to people who were doing nothing but nodding their head and listening. And so naturally they came public with a bunch of different entities, of which was the narrative it fit to sell an IPO. It didn't fit of how the businesses worked and what one should expect from them and when. And hence, things did not go according to plan and stock got creamed. And so this sort of came up in our world of following failed IPOs. And this is we've had a fair amount of experience in this area with, specialty chem companies or, excitingly leverageable and, good LBO fodder that when they come out and get on the flywheel of delivering, they get really interesting. So we started looking at this. And the second part of this is people in our world hate PE overhang.
Yep.
And there are, particularly now, and I think this is one of the more interesting opportunities that we've been pursuing and looking at, is people are hung. PE, world's smartest men, more making God knows how much money, went to God knows what school. Just as soon as they have a public investment, they freeze. They just, they don't quite seemingly know what to do. And they proceed, and people don't like that. And so this company had, over close to 50% was still PE owned. And so naturally, everyone in our world says, well, of course, I want to buy the last 5%. Call me when it's done.
Yep.
And there can be and have been successful opportunities, because also PE being PE, they're looking to sell it every day. And so sometimes it comes out through, as I'll talk about, the Ecovyst way, which was not good. And sometimes the company is sold. And in the meantime, again, we're a $400 million plus firm, so we can do these kind of things. If you're running, 14 billion, you're like, I'll just wait till the last one. Okay, so that was a big setup. They solved their problem, or started to solve the problem by hiring a new CEO who was not lead the company through the IPO, a guy named Belgazem, which, as he explained to me, I said, how do you pronounce your name? He goes, rhymes with orgasm. His words, not mine. So he was a senior Baker Hughes guy, and just, right guy, right time. He tough as nails, just went through every single line item of the company and said, this is stupid. Really, we should be 2 businesses, not 4. And he did an excellent job of just, basically walking into, I'm sure, PE and or the board and saying, this is the dumbest idea ever done. I'm going to fix it. And essentially sold off half the company, paying down debt, as well as returning capital to shareholders via special dividends, which is a nice, good little mix there. And anyway, we spent the whole day there, got a little chemistry lesson from, which I don't think I paid attention to since 11th grade, got an understanding of very detailed plan, got a sense of intensity of where he's focused, came back to the office and said, we're in, and made it one of our largest positions. And he just did an exceptional job of cleaning that out, and then rebranded the company as Ecovyst, because, that has sort of a ring to it out there.
Vaguely ESG.
So he swore up and down. His wife didn't come up with the name. But anyway, so it worked exceptionally well out of the gate. And then the next phase happened. And basically, as opposed to, and it is a running mystery of, we think this is an incredible, as Andrew would talk about, fantastic, high margins, great free cash flow, closed loop on, we'll talk about roughly 80% of their business, kind of a really interesting set of dynamics. So the question is, why would PE hire Goldman and other large bracket firms and just unmercifully bang the hell out of the stock, as opposed to like, wow, seems like a great club trade? Frankly, a mystery. And we have was one more left between CCMP and the European company that originally attributed the assets, INEOS. They've done 5 awful secondaries in our face. We spent a lot of time with management, and we got them after the first disaster to say, if they want to give it to you at $9, you should be buying. They're going to sell 10 million shares, buy back 3 or 4, delay the delevering. It's not that important. You got a 3 handle. And so net, we went through this process. The company bought back a crop load of stock through this at very, very cheap prices. And we're about to get to everything else. And now INEOS is the last man standing. They did a deal after the last quarter. So they have 7%. There's one more left. And
so you beat me. My later questions were on the PE overhang, but do you know why INEOS did the last deal?
Because they're trying to buy Manchester United.
Because they're trying to buy Manchester United, another area of focus for me over here. But yeah, and CCMP, you basically mentioned they were in this for a long time. I think they were fund lifed out, so that's probably why they were selling it. So we don't have to talk about the PE overhang. But so Andrew, Jeff did a fantastic job of going through the background, why you guys got interested, the PE overhang, how they've kind of delayed their delevering. We can talk leverage and everything, but I do want to talk about the core business, right? 80% of the core business relates to, not a lot of it is alkylate, which they've described as, we make liquid gold, right? We make liquid gold when it comes to the refinery. So I just want to turn it over to you, and Jeff, you feel free to jump in as well, obviously. Let's talk about what Ecovyst does and why their product is liquid gold.
Sure. And so the business as it stands today, just to break it down, is they've got EcoServices, which is the sulfur regeneration business, which you're talking about the alkylation process, or the liquid gold process, major part of the business. And then they also have Catalyst Technologies, which is a separate segment. So let's start with the EcoServices side. So the best way to just think about what the alkylation process does is that it makes gasoline higher octane. So the tailwind they're really riding is more turbochargers get put into cars, non-electric cars, but actually gasoline-driven cars. There will be more demand for higher octane gasoline, and that's kind of what's driving the tailwind for their additional volume behind that EcoServices business.
Andrew, yeah. So this is a simple, when I had a car, so I started a car out of college when I still drove, I would go and fill it up with the regular unleaded. And now, like my parents' car, when they drive, and more cars are going to this, you have to fill it up with the premium stuff. And the premium stuff use more alkylization. Is that it? That's exactly right.
And so there's actually a secular tailwind behind that within the the number of cars. And so with cars with turbochargers are usually the cars that need that higher octane. And you're totally right. When you're at the gas pump, it's like the middle or the top level expensive gasoline. And so the reason why this business is so great and why it's so high margin is that a lot of these they have a lot of captive pipelines into the refineries that actually go do this alkylation process and make gasoline higher octane. And so part of the process is they've got to kind of remove the sulfur from the gasoline as it's being refined, and there's they send that through a EcoServices pipeline. EcoServices kind of regenerates that, and then they actually take the new virgin or the recycled sulfur and sell it into the market. So when you look at the revenue from that business, about half of it is just them, the actual service of helping recycle the sulfur, and then the other half is actually selling that sulfur into the market.
And now, a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. And then I think this might be a little too far ahead, but one thing you mentioned is, look, they're getting the product that they're recycling and selling, they're getting it via pipeline, right? And that is, for people who aren't familiar, I'll just let you talk. Why is getting it via pipeline so important?
Yeah, it's extremely important because, there's literally a pipeline from the refinery to EcoServices recycling facility. And so in terms of, when they're drawing up contracts, they're usually 3 to 5 years, if not longer. They've got unbelievable pass-throughs for costs because if you're a refiner, you're kind of captive. To displace them, you really would have to, you have to start trucking maybe to another facility. The cost savings of just having it directly piped in makes it pretty easy for them to not lose a customer.
The real model is sort of the classic, the Air Products model. In other words, we need this done. We can't do it, don't want to do it, not part of our pie. Come in, we'll sign a long-term contract. You put in the assets and you're our guy. You're basically a captive customer. They really dominate of it in the Gulf area, which, as we all know, is massive natural gas explode, blah 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 blah. Huge competitive advantage there. So customer concentration. So you have these pipes. You have routes of collection. So it's almost like a closed loop. 90% of the contracts, or 90% of the contracts are 90% fuel and sulfur-based pass-through. So one of the key issues, you're basically providing the service and netting your margin all else being equal, and to note when prices of fuel and sulfur go up, it's good for their top line, lowers their margin because they're passing through the material. And oddly enough, when things slow down and volumes are down and prices come down, they actually expand margins, all of which net out somewhere in the low 30s on an EBITDA basis. So it's a closed loop. More demand out there for said product, and there's just very few people who want to get into this space. And the last part of other interesting thing, and then we'll turn it back to Andrew for the other side, is that it's sulfur. Sulfur's mean, nasty, and while it has definitive uses that will never go away, and actually is a green thing because you want to mine lithium and copper, you're just pumping the stuff in by the I guess the gallon, whatever, a lot more than a gallon is, this and that. They also have, they need to dispose, everything can't be recycled. It's not 100% transfer. They also have, and one of the interesting things we learned through Clean Harbors are holding is owning, whatever, Section 4 waste disposal facility is an awesome business, because it just takes 7 years and 600. It's a crazy. So they are actually had that sneaky side that's margin enhancive in just getting rid of the worst gook, both from their current customers and their internal use, as well as outside. They're not going to go out and go spend $600 million, but it's another part of that mix. And so even though people whine about, there's not going to be a car sold, and whatever numbers you look at, the fact is, no matter how many EV cars are sold in the next 10 years, the actual amount of ICE machines still running is almost unchanged under almost any scenario, unless really people are going to come to your home and take them.
Like they're taking everyone's gas stoves, allegedly. Okay, well, look, we can talk about, there's other pieces of the business. They're involved in polyethylene production and everything, but Jeff just hit on it. So let's talk about it right now, right? The big risk here is a lot of the business is coming from gas refining in some way, shape, or form, right? We haven't talked about the catalysts, but catalysts, they're important for renewable diesel as well, but the catalysts are really the turnarounds when you're doing plants and everything. So I guess the big risk that everyone said, here's how one smart friend, when he said, hey, you might want to look at it, is like, look, I'm confident that these guys are going to be selling products until the last refinery in America is shut down. But the issue is, hey, in 5 years, if right now I think about 6 or 7% of cars that get sold are onto the market are electric vehicles. In 5 years, if it's 20%, and slowly the oldest ICE vehicles start kind of rolling off and miles per gallon is improving, you're going to start having refineries shut down at some point, right? So as you start having refineries shut down, it's kind of like, how does that long tail for Ecovyst look like? So are you buying it with the next year or two? Yeah, there's some pricing power. Every refinery is running at 100% right now. But in 3 years, do you start seeing the first of the refineries shut down? In 5 years, you start seeing, in 8 years, you see like the middle piece of the refinery. Like, how do you guys think about that kind of tail or the long life of these assets?
I would simply say that what people are really missing is just, again, it's just there's nothing wrong with the social desires to green out the world. It's just the date's wrong. There's no 20, it's not 2030. It's not, and Andrew, okay, I've got 23.4 more years left in life, statistically speaking. You think you got a couple more, but we're talking, 2040. I would say well beyond any reasonable long-term estimate. And I know it's popular for people to be smart, raise their hand in a meeting and say, well, you have zero terminal value. Like, that's just BS. And if anything, so we think not within our time horizon of, let's say, 15 years, of which people will start worrying about it in year 8. And you can make, again, captive company making an absolute necessary product that I just don't think it's a relevant issue. It's a nice little headline, but the current top line organic growth, maintenance of margins, and key free cash flow gushing that's your next 7 years.
Let me just push back slightly on that. So I definitely hear you. And I do not mind. You said, there's no terminal value. And yeah, that's true for probably every business, actually. But I don't mind investing things with questionable terminal value. You and I were on stage and I pitched Delek, which is a refiner. So I've looked at the refiners closely. I certainly hear you. But, I look at Exxon sold, it was a small refinery, but they sold a refinery to Par Pacific last summer for about 3 times mid-cycle EBITDA, right? And when you're selling, and I understand Exxon's got an ESG kick and all this, but when you're selling big refineries for 3 times EBITDA, or you look at the EBITDA multiples, some of the, like Marathon's got the best refineries in the world, but if you look at anyone who's got anything a little bit under them, they trade like the terminal value is going away in 27 to 2030. And like some of the worst facilities would go away even before that. So you do start have that, hey, all these refineries are pricing in that there's going to be a lot of retirements in 4 to 6 years. That would be a lot of business going away for Ecovyst.
I would, again, life is nothing perfect. And that arguably there is absolutely, and we've seen this in other companies in ICE space, like internal combustion engine, that, there's just X% of our peers and cohorts, on both sides of the ocean, that just, that's their mantra, that's the play. You see it in a variety of things. Now, this is, obviously you can argue coal would be your argument times 12, right? This and that.
With a 12th of the multiple, too.
Nonetheless, also, I had the fortunate thing to be an investor in like the last maker of, leaded gasoline.
I think I saw your 13F. You've got Hallador in there, which has the coal and the coal plant.
So I would argue, again, I would argue just, people are embedding a 2030 number, which is just the made up number. And I would argue in many asset classes involved in this, that the infrastructure here. And so to your point, even if, whatever it is, EV cars by 2030 or outlawed here, by any math done by any, McKinsey-esque person, still look out 20 years. How many cars are on the road globally, right, that are still putting in some form of gasoline? And the answer is like, it's unchanged. I mean, so I would say that is it. And secondly, US-based company in this world, our natural gas position just buries, any refinery in Europe, right? Probably Asia, but the Middle East is the only people just because they sit on it, right? So I don't think, it's a nice headline talking point, but I really do think the math is going to march on its own drummer without that really being a factor. And we're dead on refineries. And I would argue this company should be valued somewhere between Air Products and Forex. Okay.
And I would just add one thing. So another thing about this company that we love, and Jeff's visited the research facility. They're always sort of on the bleeding edge of their space. And one thing that, again, much farther into the future, is sustainable airline fuel, which they are kind of have the top foothold in. And so if, we're thinking 10, 15 years out, the same catalysts that are used to, make airline fuel, it's the same one that, makes sustainable airline fuel. So they're part of that infrastructure. So if there's any appetite for that globally, which will add a lot to all your plane ticket fares, unfortunately, but they're extremely well positioned to capitalize on that. And so when we're thinking about this company, if we just think about it as of today, you have to think about it as, okay, if some of these refineries start shutting down, they also do have opportunities to replace that revenue and EBITDA.
Yep, that's great. Just 2 things I'd say. One, Jeff, you mentioned investing in the leaded gasoline pieces. And whenever I think about refineries of these, the quote is, sure, it's a sunset industry, but what a beautiful sunset it could be comes to mind. And like the profits from some of the refiners are the last pop in mind. And then the other thing you guys started to mention it, and Jeff started hitting it with the natural gas. Most of their assets are either Gulf Coast situated or smaller, but California situated, which means they're right on the coast. And as you said, hey, even if the US is going to be 100% EVs, we're going to be making it elsewhere. And because you're on a coast, our US refineries can just start pumping, and you're close to the refineries that can actually ship it worldwide where the demand will be. I don't know if you guys want to add anything there, but that really does strike me as an advantage for the long-term kind of useful life.
I mean, it's sulfuric acid is just it's just one of these things that whatever you don't like as society, it doesn't matter. It's a necessary chemical, required to make everything that you look around your room or live with and in. And, it's going to take decades and decades and decades to, replace an infrastructure that was built for X supply chain. So there's that. I don't, again, I really do think it's beyond the scope of a our bet is 2050 or 60, not 2030 or the next election. So it's really that simple. If you can cling to, that world's coming to an end and blah, blah, blah. And I can tell you also, I mean, literally we're in El Segundo, which for those, besides being the airport city, as like a big honking refinery that also we can take a tour anytime we want. If you want to go look at some alkalization going on, it's about 2 miles away from us, hopefully not blowing up. So I don't think it's the issue. And look, if this company, just math, put up 7 years of, mid-single digit growth with 30% push margins, and, the issue I think is much more of, wow, if you can do that, you'll get a much higher multiple than 7 and 8 on an EBITDA basis, number one. And number two, then it gets to the other issue, obviously, was capital allocation. There's a new board that's, this is post-PE. The CEO was an excellent COO and really was the builder, runner, and architect of the EcoServices of their biggest business. He doesn't have, the proven chops. There's a guy who became classic, he sold Creighton. And so now he's the genius CEO who anything in the basic materials he touches will naturally be blah, blah, blah and sold. But, there's a whole group about what to do with this free cash flow. They're down, their leverage is, even after the last share purchase is still in the 3s and dropping rapidly. So I think those are the, if we can get 7 years through nothing material, which again I don't think we're gonna make money.
So Andrew, did you want to add anything? Go ahead. We can go a lot of different directions from that.
Yeah, no, nothing. I just would say, to your point on their refineries being concentrated in the Gulf and California, you're exactly right, on the coast for exporting if it does come to that. And they've got the slide in their investor presentation which just shows their concentrations around that.
Perfect. So let's just touch on valuation, because Jeff mentioned, and then we can use it as a jumping off point for capital allocation going forward. But this is trading, as you and I talk, about $12 per share. That gives it about a 1.5 billion market cap, about a 2.3 billion enterprise value. I've got that at maybe based on their projections for 2023, that's about 8 times EBITDA. So specialty chemicals it's tough because these things do tend to trade for multiples certainly higher than 8x EBITDA, but obviously there's also a wide range of specialty chemicals players. So how do you think about what a fair multiple for this type of business would be?
Andrew, go ahead.
Yeah. So I'm going to give you I'll give you the short answer of today, and then I'll also give you maybe a little history. But if you look at, so this is 30% plus EBITDA margin specialty chemical business. There's really not that many comps that are this small. But if you look at any other specialty chem business that's publicly traded, you're getting 12 to 18x with Air Products, being at the top of that. And so from the beginning, we've bought shares in this company every time it's at 7x, and it's just head scratching to us that this business, especially with these high quality assets that are growing and have mid EBITDA, 30% EBITDA margins, are trading at these valuations. On top of that, you have to remember that 75% of their EBITDA converts to free cash flow, and that's not adjusted, that's real free cash flow. So it's trading almost at a 8.5% free cash flow yield. And so it's one of the cheapest stocks we own, and yet one of the higher quality businesses we own too. And so it's a mix of those two. Jeff mentioned this earlier, but I just want, for people who are new to the company, their revenue is very choppy. It looks just, and it doesn't screen well because last year especially, they had a massive revenue increase from sulfur product pass-through. We're talking significant amounts. And so it looked like their revenue was going up 40%, and their margins were actually going down because it was just a pure pass-through. So if you're looking at just sort of the stable business, you have to clean that out. And what you will get is, mid 5 to 6% EBITDA margin, growth, or sorry, not growth, 5 to 6% EBITDA growth on a pretty similar revenue growth. And so, it's still to this day extremely cheap, even though it's, sort of hitting, $12, which is sort of new highs for it lately.
When I started prepping, one of my first questions was, because Q1 revenue was down, it was going to be, hey, why was Q1 so soft? I thought this was a stable business. And then you read the footnotes and you're like, oh, it's all passed through. And I was like, Jeff's going to yell at me for not doing work, for not being a real researcher here.
No, it's a legit. So yeah, like we like to invert, like, okay, we bought this stock at, I guess net, whatever. We bought it a while ago. We got paid dividends and worked really well on it. It's kind of flat. And really what could go wrong here? What do we see? Something like, wow, a PE firm thought to just bang it out in the market at the low multiple as opposed to selling the whole thing. Like, what don't we know, right? Then there's a second area of, again, there's the ICE contingent, right? I shall not invest in anything remotely involving anything like this, taking off the thing. But I also think, again, one of the key things is also no one likes, or very few people like, and we don't like it, right? It's like, we see the opportunity. Wow, someone owns 70% of this. It's going to go some way. People float small, ergo, we can get in, others won't. And we have been very successful in the past because often it results not just in a series of painfully, shockingly, poorly executed secondaries, like we've seen here, like the whole thing gets sold. So I think people are kind of sort of waking up like there's one more and it's going to come after the next earnings. Also, they make the claim, and they show a chart of the 19 years of blah, 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 that show how not cyclical they are, right? Because this is a mandatory element. It's a closed loop system. We've got all these pass-throughs, could be wronger. And so when you see something like the first quarter, it's like, obviously we're being fed material to support a thing, and you have to say, maybe are we discounting that concept enough that for whatever reason there is less miles driven, et cetera, et cetera. And the last little weird thing is this company's hard to screen because in the catalyst business, which is the other 20%, is a part of it. It's a big joint venture with Shell in Europe. And so, like, a big chunk of numbers is not, quote, above the line, it's below the line. So, and when they say adjusted EBITDA, we yell at them and say, no, BS on stock comp, blah, 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 real EBITDA. But it is fair to say you've got to, when you're, people screen for the company, that a good chunk of math doesn't show up because it's not above the line. So you have to adjust for that. And I think that's one of the reasons people don't, if you just got on Bloomberg and spent your 2-minute drill and say, oh, it doesn't look that cheap, you kind of miss it. And that's kind of a fun little thing about, the old doing the work thing. Andrew,
yeah. And so I gave you the shorter sort of version of, what's happening now, but just a quick also on sort of the longer term. So Jeff's alluded to this, but I want to put some numbers around it. So we invested in late 2020. The stock was about $11 back then. Since then, we've collected about $5 in special dividends. And they used some of the, and they paid down debt as well. But what they did really was, and why we really like Belgasm, is they had two mid-20% EBITDA margin businesses, which they said we need to get out of. We want to hold on to the crown jewels. And so when we bought in late 2020, again, 7x EBITDA, we were buying it at, and they sold those mid-20 businesses for one with an 8 handle, and I think one with a 9 handle multiple. And that's how we got those dividends and there's a lot of debt pay down. And so we're just sitting there like, wow, I mean, the lower quality businesses are trading for, 8 and 9x. And now we're sitting here with what are arguably the best segments, and it's still trading at, 8 times. And so, and then another sort of comp we want to put out there, and this is on a segment maybe we should go over real quick, but, on their catalyst technology side, the number one competitor is Grace. And Grace in 2021 was sold for 12x.
Oh, I pulled up their proxy and pulled all the peers yesterday. Absolutely. But please continue. And so when it's just, there's just this divide between public market valuation and private market valuation. There's direct comps of businesses that have been sold, and everything leads us to believe that this is not an 8x EBITDA business. And they have the cash flow to back it up too. So that really gives us comfort. Just a quick question. Their adjusted EBITDA number they report, that does include the earnings of the JV. Am I misremembering that? No, that does.
That's correct. As they report it, that's correct.
But so on Bloomberg, it doesn't. Okay, just making sure I didn't have that.
Take out $20 million for the stock comp. Let's just get that on the record. We hereby count stock comp as a compensation expense. Boom.
I can appreciate that and fully support it. Just quickly, so we mentioned CCMP and INEOS. We already talked about why they sold INEOS because they want to go buy Man U, even though I think they're going to lose the Qataris. CCMP because they were just timing out. But as you mentioned, hey, these businesses, they can handle a lot of leverage, right? The CEO will come out and say, hey, we're at 3x leverage now. We've been at 6x leverage. We've got great visibility. We can lever these things up. They tend to go really well in private equity platforms. Why do you think CCMP didn't explore a sale or couldn't pull a sale off or anything instead of kind of just blowing through really tough to do secondaries?
I asked and not answered. We've talked to people in the banking community. We've talked to all the relevant players that may and may not have been mentioned. And, obviously, I would say that maybe at the time that the, anti-ICE world was, it remains, I will admit, it remains a mystery because particularly how they executed it. There's nothing worse than having Deutsche Bank or Goldman doing a secondary for a small cap company. I mean, it's just, they have they just don't even care. They don't have the bodies of where the stock goes and where they kept selling it. So I don't really have a good answer to it because, the world is semi-efficient, right? If what we believe was as believable as we're saying.
Exactly.
It's a known unknown risk factor that we look at and go, is there something really we're missing here that negates this narrative?
Even if you guys, like you mentioned a few times, double-digit multiple, right? Let's just say that implies a $20 per share price. I'm sure, like, I've heard people when a stock's at 10, they're like, if somebody tried to buy it for me for 20, I'd be furious. I'd be like, you know what? I'd probably take 20 and I'd go and try and find something else. But, last year, CCMP and INEOS combined, they own about 50% of the company. You guys probably wouldn't be furious if they tried to sell the whole thing for 13 versus 20 or wherever you think the fair price is. But for CCMP and INEOS, they controlled the company. It would have been a huge premium to the $9 they were selling at. It's like, hey, yeah, it would have been below fair value, but why didn't they just go inside? I hear you, but business can be unknowable that way. But it's just curious.
Yeah, I can add a couple things there. One, so for CCMP, it was in a 2014 fund. So they were really at the end of life. This was, they need to get it out. And then I think the other piece is, I don't think these businesses would be sold together. Jeff mentioned this was an IPO of basically two disparate businesses smushed together and then brought public. And so I think to be sold, it would probably have to be separated and then sold in pieces, similar to what they've done with the two other business segments that they've sold. And then on top of that, what do you do with the JV? How do you sell that? What are the complications with Shell owning the other 50% of it? And so I think there are, it's not as easy as, okay, we're gonna, sell this one sell this and spin it off and then sell the other piece. But it still is a big question mark. So, but it's not.
Anyone has any, please contact us at CoveStreetCapital.com if you have a really good answer for that, because it's a stumper.
Let's talk about the go forward. So as we speak, there's one more INEOS sale to come. As you said, it might be after the Q2 earnings, but the company's in good shape. It's 3 times levered. They're going to generate a ton of cash flow. They've been buying back shares. But the CEO has also been clear, hey, I want to do acquisitions. Since they did the last deal, I think they bought it was like Echem 42 or whatever. They did a small deal alongside it. And he's been saying since then, I want to go buy things. I want to bolt things on. And that's what specialty chems do, right? They go and buy stuff for 6x and they get a little bit of synergies and the whole thing's worth 12x when you roll it up. But they could do that. They could just keep returning cash flow to shareholders. Eventually, maybe so can. How do you guys kind of see the story playing out over the next 3 years?
Well, I would say most people sell for 6x and buy at 12x. So, I would say
I laugh, but I can't tell you how many companies I've done that, and I've done it once or twice in my portfolio as well.
It's a very expensive lesson to learn to be. We have a joke thing like everything eventually becomes a toaster, right? So what is specialty chem? So, but that, as we pointed at the beginning, a known unknown here, and we've spent a fair amount of time with board and company, and I think they're not wild-eyed. I would say the CEO is really good to run the business and maybe identify like a Chem 32, which has been a monster home run. I don't smell this massive, we're going to lever up to 5 times to do something. Could there be bolt-ons? And again, the capital allocation in a free cash flow company that's got this wondrous thing that's steady, a lot of your incremental, PV of future value is what did they do with the money? My guesstimate is like 3 is enough. It's fine. You don't have to go, you don't have to be one-time levered. I think that's inefficient. We'd be screaming about that. But, they're on a next inflection point of what else can we do? And that's, as we say in life in here, sometimes like we'll let you know in 3 years the answer to that question.
Yep.
Right. Andrew, do you have any?
Yeah, I'll just add to that. So in April of 2022, when all these secondaries were coming out, they also press released that they authorized a $450 million share repurchase. And considering the market cap of this company, I mean, that's almost a third of their market cap. Now that's over 4 years, but I think they've made it pretty clear and signaled to the market that they're buyers of their shares at reasonable prices. And that's what they've done so far. And a lot of that's been through the secondaries. But we'll see if that translates to open market purchases.
But I think there's an organic, I know oddly enough, and every company, touts his greenness. And you change your name to Ecovyst, you better, have something to say. But in all seriousness, the things like anything biofuel requires interesting chemical technology to these catalysts to help in nature that, and and whatever area, California, we lead the world in grossly overpaying for things. So to make ourselves feel better,
LCFS and
we love this stuff. But in all seriousness, there's not a single area of somehow fuel that is involved here. There is, again, you can green all you want, but you need lithium and copper to enable this world, and you cannot mine lithium or copper without just vat loads of sulfuric acid, which needs to be recycled so it's not sitting in a pool and blah blah. So there's lots of interesting, debottlenecking on existing platform type mid-single growth that looks pretty doable. I mean, there's always ebbs and flows in whoever's running the government and what the regulatory environment will be. But, in general, we're not going to go away from looking at bio and trying to commercialize this, which is a huge benefit to them. So I don't, yes, bolt-ons would be neat and lovely and well done if well done. But, I think our thing is mid-single digit maintenance of low 30 margin, 75% free cash flow gen. That's more than sufficient at current valuations to make good money.
It jumps out to me. Just look, we talked about the refining side again, the ethylene, the liquid gold. If we're going to be producing any type of gasoline, that stuff is it's required, right? Like miles driven really doesn't fall short of if we lock everyone down for a pandemic or something, right? So you've got this great business that should be very stable because you're in the pipeline. You should have decent pricing power because it is a very small component of the overall cost and it's absolutely critical. This just strikes me as a business that's just absolutely primed for financial engineering, where let's keep our 3x leverage steady. Let's grow 5%-ish on the EBITDA line. That means we can keep the 3x leverage steady. So we take the cash flow plus an extra 5%, buy back shares every year. Like, it's a really, really nice growth algorithm for shareholder value.
Whether or not they're going to do that remains a question, right? Because that will be, again, the known unknown, right? He's a new CEO. There's a new board, like a whole changeover from the whole PE brain. And so I would say, I don't see them as, if you look at it, they're not, they don't have like $12 a share of cash and won't do a damn thing. And they're not, crazy. Let's just like roll up and do 7X guys. It's not clear. So there's somewhere in the middle. So I'm not sure that, obviously from our standpoint as financial geniuses on this call, right, we would argue for exactly what you said and help do it. And they've been doing that to some degree. I think the share repurchase brain was really, we beat them into it to say, if they're going to sell stock down 17%, you should buy it for us. But
that's one of the nice things about being a loud page one shareholder. And I mean, page one shareholder for both of you and loud mainly for Jeff, but that's one of the nice things, right? You can call them up and say, hey, let's do something that's really going to create a lot of money for everyone except for these guys who are selling to you.
It ignored plenty of time. Page one doesn't always help.
Just real quickly. So I've mentioned a few times, alkaline liquid gold, it gets in through the pipeline. It's on long-term contracts with captive customers and everything. Obviously the revenue line comes and flows because they're passing through a lot of this stuff. But in terms of pricing power, when people are just thinking of that, like, this is something that attracts me. Look, you're providing a small cost and it's an absolutely critical component. You've got a captive customer. If they want to replace you, they literally need to start trucking in from 500 miles away, just that cost. What sort of pricing power do they have with their customers as kind of these contracts come up for renewable? That's been a big piece of the Air product story too, as Jeff was mentioning it earlier.
Andrew, you want to?
Yeah, no, they, especially on the EcoServices side, they usually just have contractual, price increases, nothing major, but a lot of the times it's just sort of, they tick up, And
they don't get big bumps when the 10-year or 3-year or 5-year contracts come up for renewal. They don't get big bumps at that point.
I think it's sort of like a steady,
Okay.
They have good relationships with their customers. They're not looking to, bump it up, but they're looking for that definitely that price increase, nice and steady every.
It's a mutually assured destruction.
Exactly.
It's if
you've got the pipeline, if nothing's going through it, you're losing out just as much as they are. So.
That the refinery, and the way, if you go walk around a refinery, there's all these like little, what's the word? Boxes of stuff that looks complicated and interconnected. And even though that might not be yours, you might lease that space to someone like Ecovyst to do that. You don't want to rub it in people. I mean, this is a small company and your customers are, every big refinery in the world. Like, you don't want to, they could flex. They really don't want to, right? And so it's sort of a, we're here, we've had a 10-year contract. You're going to really pick up this. So it's the pricing. It's not as much. The pricing is much more maintenance of margin or maintenance of profitability. So that's the key thing. I don't think it's per se about the refinery. If there's a huge uptick in demand for alkaline or, for whatever reason, or sulfur, the refinery, frankly, is going to see most of that. Like, this just the pricing of the thing, and they'll benefit tangentially from that. But it's not about, we're on space and we're going to shove it to, and even Air Products doesn't wake up, they're in there because they have a record of not like, hey, we put in 100 million to do this for you. And I know we have you captive, but I'm not going to treat you like that. And that
makes total sense. There would be a lot more we could talk about if we wanted to really dive deep in here. I did want to ask on a few questions on a completely different company, but before I go there, just anything, again, there's a lot of other stuff we could cover, but I think we did a good job hitting all the high points. But is there anything you guys kind of think I missed or wish we could have hit a little harder that you think listeners should be thinking about?
Yeah. So we didn't hit really the Catalyst Technologies section at all. I'll just give like a 1 minute. So they basically, there's a silica catalyst side. That's the almost direct comp to the Grace business. These are, they're actually, specialized and produced catalysts for each individual customer. So that's why you get such high margin. These go into like HDPE plastics and MMA plastics. So it's relatively stable and not really as bumpy. It's more of market share gains and losses versus industry gains and loss, or sort of like industries going up and down because it's tied to plastic end markets. And then the JV we mentioned with Shell, it's for hydrocracking catalysts, and that is lumpy. And that's just something to really note. The reason is the way hydrocracking catalysts work, it's almost like a cartridge. The way to think about it is you like insert a cartridge, you deplete the cartridge, and then you buy a new cartridge. And so it's not, so they'll have some quarters where you're looking at it and you're like, oh my God, this is, it's growing massively. No, it's just, it happened to align that all those refineries needed new cartridges.
Had turnarounds at the same time.
And so that's just another layer of complexity, which doesn't make it a smooth, grower all the way up. But if you look over the long-term trends, it is.
And now a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are. And you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time.
Perfect. Look, obviously we announced this podcast yesterday. We've been planning it for a while, but this morning there was some news on Viasat, and I got like 4 inbounds. Are like, hey, you have literally the top holder, the axe on Viasat coming on your podcast. You have to ask them. So for people who don't know, it's July 13th. Viasat last night announced they were having issues with the satellite they had just launched. And I'll just turn it over to you guys. I don't know if you guys have any thoughts or if you want to share anything. I know it's kind of a developing situation.
First, a moment. Yes, an off spreadsheet event, let's say. So we're right back. I mean, in a nutshell, not to go through everything else, there is a distinct probability of an insured zero for the first of 3 satellites. This just take everything Viasat's ever put out or anything we've ever said or any spreadsheet and just change the date. And bizarrely, so that's what it is. Now the stock's going to sit here for, in and around the 27 to 33 for, another 9 months until Viasat 2, which will be now sort of repurposed a bit to cover both to provide capacity. And that's really the company was out of capacity in Viasat. Now, the weird thing was, so that's where it stands. The counter narrative, just sort of like ICE is the counter narrative to Viasat. The counter narrative to Viasat is everything will go LEO. Et is a better model. GEO is a dying dinosaur, and blah, 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 blah. And sadly, we can't prove or disprove that until Viasat 3 is in the air, and either that is going to earn, a return of in the 30s, which it won't now, because on a time value of money, it's going to just go down. And you can argue, wow, are there customers who are going to get pissed who got, all the airlines all signed up and they're just desperate for capacity? Non-zero, but no. And the bizarre thing, though, is, we bitched when they did the Inmarsat deal. And because we thought, like, we have this totally aligned with the defense business. We're about the price of the stock. The amount of return and math that is going to come out of a warehouse and go into the sky and get projected on this share base was just nuts. And we thought at the time that the MRC deal non-zero of being a master stroke of industry consolidation, lots of good things to happen, but also like, oh my God, you're diluting the effect of your everything, the Viasat 3 constellation. You're diluting us on that. Well, good thing we have it. So
I was doing the math because they bought Inmarsat for what is it, 850 in cash plus 3.1 in stock, so we're rounded up to 4 billion, right? And is that right? Oh, and then the assumption of debt. I'll have to go relook at everything. But I was doing the math. I was like, oh, Viasat is at about 3.5 billion right now. Like, you get the government business.
It's just 2 words: effing annoying. I mean, right under heading of off spreadsheet event. So we got the launch, we got the thing, everything's working fine. A third party, of which it could be one of 3 companies, probably Northrop.
It was confirmed it was Northrop, wasn't it?
What?
I think it's been confirmed.
The company has neither confirmed or denied, but there's a lot of, you can go dork out on Twitter, and there's lots of like astronomer, there's lots of real niche guys who just follow this space. So I would say they had to put something out. The antenna is, in some way locked like a bad shoulder, and they're, effectively doing jiggling. But this could be a zero. And
they're doing the old hit the TV a few times to get it to work on the set.
I kid you not. That's literally what it is. So net, just basically the company, again, you build capacity that is needed or not, and it has a return on investment of mid-30s or not. And if you don't do that, then you're sort of stuck. So while they can repurpose a little Inmarsat and all this and that to help with the huge demand needs, it's just blowing out the numbers 18 months. The other weird thing so this was insured, which, beats a sharp stick in the eye, but, that's still not fun. And oddly enough, one of the other things, the second satellite is already pre-insured, because guess what?
Insurance and insuring that third one, I would guess.
Just went up, so to say. So, for us, whatever, this is a sharp stick in the eye, and we're, arguably,
So this was insured against, because this would, I think they said in their PR, closely with the reflectors manufacturer. It's a manufacturing error. So one of the worries I had and a few people had was, hey, you're probably insured against the rockets going up, the rocket explodes, it explodes on the launch pad, but it's also insured against manufacturer failure in the air.
Exactly. So yeah, they're good for that. I mean, obviously there's going to be lawyers and things, and, insurance companies don't like to pay, and people, this appears to be a fully insurable event, and the second satellite is insured under the same math. So, but how is it not frustrating? I mean, really? I mean,
well, as I told you though, look, this obviously today's share price isn't fun, but if all of my companies could have the equivalent of a satellite going up and let's just say exploding, a satellite going up and exploding, their stock could be flat on the year, I would take that for all of my companies very happily.
The story of life is, if the market finds your exposure and punishes it, that is what I have learned. So whatever, it's, we're back. It's frustrating. It's going to cost us, 250 basis points today, which, we're having a really good year even with this. So, but look, there's more than 12 other satellites with this exact antenna. Harris did the last satellite, the VSAT 2, and that was a screwed up antenna. So there's no the world, it is a ridiculous concept to have a satellite with an antenna and send it up to space. That's not the case. And, the story of life. So they're, working, I feel worse for me and our clients today, but I feel, imagine being a head of a satellite company, you're supplying, and there's 4 people in the world who could do this. And I'd love to be in that room and hear that rant.
I had notes and I hadn't started diving into it, but I did remember that VSAT 2 happened, and that whole constellation turned out to be a success. If I remember.
There wasn't a constellation. That was a single thing. Yeah, that was one of the panels. So it probably was operating, net life of satellite at 85% what it was. And again, they got a material, payment from that for that damage. Look, if this satellite, the issue they're going to have is do I want? It looks, they said it basically looks, there's there's a pretty decent high probability of a zero here. Just we sent it up, and oddly enough, Viasat has always been fighting against SpaceX and Starlink for, space debris issues and blah, blah, blah. Well, we just put the largest piece of space debris. So net, the company is going to be in 3.5 weeks. They had to put out a press release because something's happened. They're literally 24/7, 365 right now on evaluating this issue. So people could, but the worst case scenario is they get paid $420, and we just ate 18 months of, aggressively big free cash flow growth as they took, really you just look at it. It's like building a building. You build the building the day before you start leasing, you look like crap because it's sitting and not earning. Yes, shoot us. Yes, very annoying.
Oh, it's annoying, but look.
And it's only 8:30. We can't start drinking either. It's not appropriate.
Well, it's 11:30 Eastern time if that helps you with it. But
now there's what we got on the podcast, Andrew. There's that kind of wise wisdom by Andrew.
Look, guys, I really appreciate you guys coming on. It's been great to connect. I appreciate you talking about Ecovyst, which again, it's really interesting. And Viasat, appreciate you giving some real time exposure. Look, it's been great, and we will chat soon.
Thank you very much for your time. We appreciate it. Just for the record, I met Andrew for the first time at our Merkel meeting. I frankly didn't know what a smart young man you are. And
you came out and were like, oh, I just thought you were a podcaster, which I wasn't sure if I should take that as an insult or
another jerk off doing a podcaster. This sounds like, wow, this guy's got game. So
I appreciate it.
When I heard that, I just wanted to say that before they come allowed. But when I met you, I'm like, okay, we'll do his podcast. Anyway,
I really appreciate it. It's been great, guys.
Thank you. It's been great.
A quick disclaimer, nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.